Good day, everyone. My name is George Zarya. I'm CEO of Sequent Capital, and welcome to our webinar on cryptocurrencies. Before I start, I would like to say a couple of words about our company. We are a hybrid broker, advisory broker, regulated by FCA. Although the company has been around for 10 years, we are going through a rebirth with a new robo angle to our business. We will soon be launching our first robo product called BigQuant Protect. It will enable clients to build and execute structured products using exchange-listed options in a matter of seconds, with a very simple visual interface with interactive infographics, very user-friendly. Go back to cryptocurrencies. This is a special sector focus for us. And this is a relatively new asset class, and we feel there are a lot of informational gaps and a lot of synergies with what we do on the securities market. I'm personally a big believer in crypto assets, and I'm very excited to see what is happening to the market, and we're looking to participate in the sector one way or another. Today we're looking to cover quite a broad spectrum of topics and to give you a well-rounded view on what we think about cryptocurrencies and how you can capitalize on this growing asset class. We have two sessions where I will cover the fundamentals and go over the key factors that investors should be wary of when investing into crypto assets from the longer run perspective. So the key part of the presentation will be dedicated to fundamental analysis, or the factors that we would recommend to look at, and the approach to evaluating the individual coins. And in the second part, my colleague Stephen Beckett will be covering a more of a short-term view with a technical analysis application, and this will give you a perspective on where the market is going in the short run and how you could actually trade. He will do a live tutorial of the platforms we're introducing. And so by the end of the webinar, you should have a good understanding of the sector and hopefully understand the benefits of working with Sequent Capital. And we can cover all of your questions at the very end. So let's start with the very basics and define terminology. The original term for the technology was a proof of work, not blockchain. The later they renamed it to blockchain, which means is that these transactions work is being recorded in a public decentralized ledger, and the key features of the blockchain is that it is distributed, meaning decentralized, similar to how peer-to-peer technology works. B, it's cryptographic, which means there's an encryption of messages with the public and private keys and passwords. And finally, the immutability of the database. This is a very rare feature in the technology, and in the technology world, and it's what makes the whole technology unique and valuable. You cannot delete it, replace, or manipulate it. So relying onto this characteristic, the distributed computers agree on which group of transactions will be appended to, for example, Bitcoin's blockchain next. And to put it another way, the proof of work specifically deals with how transactions are grouped in blocks and how those blocks are chained together to make a Bitcoin blockchain, essentially. And once it's chained, you cannot remove the block. So this is the whole concept of immutability. We would not classify the majority of the cryptocurrencies or crypto assets as currencies, but rather most are either digital commodities or crypto commodities. What they do is providing raw digital resources. And the third subclass is digital token, crypto tokens, which then provide a finished digital good and service. So a currency fulfills three well-defined purposes: serve as means of exchange, store value, and serve as a unit of account. So to simplify this, you can imagine we can take an Apple Pay with an App Store. So the Apple Pay essentially serves as Apple Pay money serves as cryptocurrencies. App Store is a crypto commodity platform, allowing to build services and create value. And all the apps within the App Store are crypto tokens delivering the end good. So in our increasingly digital world, it only makes sense that we have digital commodities such as computing power, storage capacity, network bandwidth, and so on. So that's where this all going to. Beyond cryptocurrencies and crypto commodities, and also provisioned by blockchain networks, the finished products or digital goods and services like gaming, media, social networks, and more, increasingly more. And they all orchestrated by crypto tokens. So moving over to regulation, we have a map of the overview of what the regulation currently look like and how different countries what different countries view on the regulating crypto assets. We've seen governments debating on the topic of cryptocurrencies, and many of them feel that allowing cryptocurrencies for legal transactions would basically mean and result in loss of economic power and a shift towards the decentralized economy on a global scale. Well, even though many countries across the world permit cryptocurrencies, they have been under quite a lot of scrutiny and seen with skeptical eyes and many others. U.S. in particular, wary of ICO hype that seems to be coming to an end, to be honest. And there are a few court precedents which lay out the ground rules for the crypto space to be regulated. UK has not published any regulation, but our conversations with the FCA point that they certainly dislike what's happening in the market and are studying it. But my guess, the actual regulation won't come earlier than 1 year from now. So there are certain countries have gone to the extent of banning the currency altogether, making its use, possession, or trade illegal, like China and Russia. Although Russia is investing heavily into the infrastructure at the government level and most likely will start regulating the sector pretty soon, and China has a currency, a cryptocurrency that is backed by large corporations that is also showing some support within the country, and my guess would be that down the line China would introduce some regulation as well. So the going back to EU, Europe's approach towards the blockchain technology is quite positive and welcoming. So it appears that they following the path of the innovation first business philosophy, which could end up quite supportive in development of virtual currencies from several angles. So encouraging the use cases to test impact and laws, exploration of the use cases, and giving entrepreneurs confidence that their approved applications will be trusted by their target markets. Very important. And so this approach could not only encourage the ecosystem, but could also end up making Europe a prime destination for blockchain development. So as business choose the continent for their home base, and the talent also follows. Going over to the current state of the market, we have a picture of the Gartner hype cycle that lists new technologies and rates it in terms of the stage. So the Gartner hype cycle has a good comparison of where different technologies stand, and the very positive thing that it shows that the blockchain technology is past the peak of inflated expectation stage and moving towards the trough of disillusionment. What does that mean, actually? Why I'm saying this is positive? Blockchain technology, including cryptocurrencies, they are slightly, the two are slightly different. So the blockchain is quite a it's quite a broad concept, and I think the cryptocurrencies in particular are a little bit ahead of the curve. And this is basically the decreasing hype over the ICOs. I think that's what means by the trial of disillusionment. And there's been a lot of issues with the hacking and security part of it. So we are going through a quality cycle, and this is a very natural process, and the time when the believers take a more focused approach and increase the depth of the industry by perfecting smaller parts of the ecosystem. So, for example, the exchanges and the wallets that service the industry have gone through a few failures, and on the path to enlightenment. We've seen attempts to launch a decentralized exchange, and there's been a quite successful ICO recently, and the new launches continue to happen with many different innovative features. So the trends we should be looking at, and sort of conclusions we can make is the mass adoption of the technologies is happening, and it's almost widespread. And we're going to look at another graph that shows how widespread the adoption of blockchain is happening. So there's a lot of corporates who participate in the sector one way or another. Very large corporates as well. So we believe the regulation is inevitable, because the ecosystem of blockchain is integrating more and more with the fiat world, or fiat currencies world. And the launch, as an example, the launch of the futures by CME evidences that. There've been some speculation. Amazon is registering a number of crypto domains that could potentially mean adoption of cryptocurrencies in its own Amazon ecosystem. As a separate trend on its own, we see the introduction of derivatives, and the market efficiency and price discovery processes will become much more advanced and efficient, and this will lead to lower swings, and volatility would decrease. We don't see it yet, and this is something we can definitely capitalize on, and Stephen will share some thoughts about this shortly. The new hype will be, I think, will be related to commodities and tokens, because that's where the functionality, that's where the practicality of the whole industry comes from. So we see an explosive growth in the market. The immense pace of the ICO industry in the past year, this mass adoption of it's happening with a frightening pace. I guess it's frightening mostly for the regulators, but we have reached the point when the market started to digest institutional money, and this growth is likely to accelerate as regulation around the sector clarifies. Speaking to the community, one of my colleagues mentioned that when running ICO, the retail population is no longer has the level of participation as it used to be. It's the institutionals that do take more proactive stance in the placements and crowdfunding exercises. Many private investors get burned, and that's a natural thing. I mean, that with the unregulated, high growth sector, there's a lot of risks. It's worth to notice that Bitcoin lost its dominance, and its share is gradually decreasing over time. Again, this is I think it's a healthy trend. So the other thing is we should notice that the market cap is supported by the number of transactions. So it's not just purely investing activity. The coins are changing hands more frequently, and for non-speculative purposes. Okay, so we've seen, again, to repeat that, we are seeing more and more cases where large corporates and the governments adopt the technology. And this is an interesting graph from the Accenture that outlines next year as a big one in terms of banks and capital markets participants going to a mass adoption. The level of service providers grow tremendously. So this is essentially the beginning of slope of enlightenment in the Gartner's hype cycle, when the major productivity just kicks in. Now the main part of my presentation is looking at how do we actually value crypto assets. And one of the most important differentiators of this asset class and its reliance on factors that could not be applied to conventional securities asset classes. We can certainly apply modern portfolio theory, and if we do, we can characterize cryptocurrencies as highly volatile, uncorrelated to the market, to the conventional equity market, or fiat currencies benchmarks. It's a high-risk investments, which could translate into a high return, high potential return investment as well. If we were to advise on the composition of the, let's say, a pension fund for millennials, that's what I think is a good angle to look at it. In my opinion, the cryptocurrency should certainly be included in the portfolios. And the asset allocation principles presume you should allocate a portion to alternative investments, and the cryptocurrencies fit very well into the alternative sector. So now let's talk about what sort of analysis you could perform looking at each individual Bitcoin and altcoins. So the rationale or the code behind the blockchain, it is very important. The Bitcoin as the mother blockchain, or has a simplistic rationale. Its purpose to be digital currency, and in fact it's become a digital gold or gold standard, meaning it's a sort of a benchmark. That's why there's a lot of traction. The Ethereum, for example, on the other hand, they was created with the purpose of developing a decentralized world computer with processing power being its main commodity, and accommodate various apps on top of it. So similar to the analyzing the management of companies when you do research, stock research, we need to make a due diligence on the team and the developers. So it should be easy to tell the difference between a scam and the real deal. So the key differentiator there is it's good intent and the way it's being communicated, and the rationale of the developer team behind the issuance model. So again, Ethereum, its founder Vitalik Buterin was a journalist covering tech sector, and when the idea was born, it didn't make much time. He didn't take much time to spread and popularize the concepts of his platform, and gain traction very fast. The recent example in cryptocurrency, for example, I came across called Lisk, which I had learned about very recently, and the concept is very similar to Ethereum, and its founders are very proactively promoting the platform, meeting with miners and supporters, and what they did is they partnered with Microsoft to integrate into their cloud computing network. So this helped quite a bit. They went up to top 6 by capitalization since only March 2016. So the marketing effort of the team is quite important. The pre-mine percentage, what it means is this is the free float at the issuance is or number of total coins, the percentage of total coins being released at pre-ICO or shortly after. The large number of such issuances, it basically disadvantages the broader community. Hence, the practice is not widespread. Moving forward, so mining difficulty, quite important as well. Essentially it's a factor of competition amongst the miners, and you can find actually a chart for each of the currencies that calculates precisely how difficult it is to mine and the reward that you would get. Issuance schedule, again, it's one of the sort of the DNA of the coin, and it's in the code of the blockchain as well, and part of the rationale. You can estimate the basically the inflation rate or deflation rate, and it gives it a static value in terms of inflation. For example, Monero, it will have a small degree of inflation for its entire life, beginning in May 2022, when 0.3 Moneros will be released every minute. At that time, there will be around 18 million units of Monero outstanding. So the inflation in that first year will be only around 0.9%. Interestingly, in 2040, for example, there will be a nearly equivalent number of units of Bitcoin and Monero outstanding. And from the period from 2019 to 2027, Monero rate of supply inflation will be lower than Bitcoin's, but in other periods the opposite is true actually. So processing capacity, quite an important factor as well, and there's a lot of debate going on about that in the industry. So the number of transactions, or at its most basic level, they just made out of data, and is usually composed of the information regarding the transaction itself. So this data takes up space on the block it is included in. So currently each block on the Bitcoin blockchain is able to contain 1 megabit of data, meaning that the block size of the Bitcoin is one megabyte. This means that there's a limit to how many transactions can fit into Bitcoin's block. According to the data contained and in different transactions may differ, and many claim that the increase of the block size can result in the centralization of the mining process. So that gives an unfair advantage in some cases to parties who can have the advanced hardware and the requisites to the mining would become much higher. And so there are pros and cons to the overall increase of the block size. So the positive things is the current block size limits Bitcoin use to 7 transactions per second. This can force regular users to compete for transactions by increasing the fees and pricing some users out of the network once Bitcoin is popular enough. So a greater block size would allow miners to receive more transaction fees without the need for users to pay higher fees. So many claim that the block size increase would also put too much weight upon the miners, given that the increase in storage requirements and the blockchain size would not increase exponentially overnight anyways. This would simply allow the network to grow as the demand grow with it. So on the negative side, the bandwidth requirements of the full nodes, which will also increase the full node count to be reduced. So the fact that some solutions do not require bigger blocks on the hard fork to take place in order to increase scalability. So many claim that bigger block size will just not be necessary. And without going into too much details, so it's a very technical arguments that not easily comprehensible, but the time will show which proponents of which philosophy win. So liquidity, obviously, that's a very natural and very important factor in trading and investing, as well as it defines the liquidation risk and liquidating the position in a short period of time. It lowers it's important in terms of the costs as well, and the better the liquidity, the tighter the spreads, so that decreases the costs. The infrastructure that supports liquidity as well. So the Bitcoin as a gold standard is widely covered in many cases. Buying an altcoin is possible only via Bitcoin, because the infrastructure was just not good enough for each individual altcoin. So this applies to the exchanges, the wallets, even the banks. I mean, the banks would open an account to invest in Bitcoin, but would not allow you to buy Monero, for example. Fungibility, which refers to the fact that any unit of currency is valuable as another unit of equal denomination. So we take a Bitcoin, for example, right? The problem there is that for balances known to have been used for illegal activity, and if an exchange or other service blacklist that balance in particular, and it means that it becomes illiquid and less valuable. So that's not a problem for Monero, for example. This is perfectly fungible altcoin, and its characteristic is attainable to the coins with anonymity in mind. So the privacy, this is again, it's a questionable parameter, but due to the controversy around the anonymity and the ease of money laundering activities and so on. But this is certainly a factor that needs to be considered. There are currencies like Monero, there's Zcash, there's Dogecoin, Dash. They're very much focused on the anonymity factor. And we can see that Monero and Dash are in the top 10 list of most liquid coins. And now we're gonna go to the technical analysis part, which Stephen Beckett would present.